Thank you for those of you joining us from anywhere in the world. So either good morning, good afternoon, or good evening. This is a topic that has been very influential for us here at Determine over the past several months, and is something that we've wanted to do a webinar on for some time. In fact, even starting late last year and working with some of our partners who are joining us on the call. And the idea around paying electronically, e-payments, is something that isn't necessarily new to the world of procure to pay or accounts payable or procurement in general, but it is something that has a lot of evolution and is really being tied a lot to the idea of how the consumerization of electronic payments is also influencing what we're doing in B2B. So over the next 50-some minutes or so we have for this discussion, we want to talk about a lot of the different things that we're seeing with regard to e-payments and understand how we could better understand for promoting it internally, for understanding the value, as well as for getting our suppliers on board into these processes so that they can adopt e-payments and find the value for themselves. But before I do that, what I'd like to do is introduce our panel here. We have quite a few folks that are joining us and want to just give them a brief introduction. So starting off first, I have Andrew Bartolini, who's the Managing Partner and Chief Research Officer at Ardent. Andrew is joining us from the East Coast in the Boston area. So I want to say late good morning to you, Andrew. How are you doing today?
I'm doing great, Constantine. Hello, everybody.
Excellent, excellent. How's the weather in Boston nowadays? Do we have finally spring, or is it bad?
Oh, we were 80s yesterday. It's going to be 80s today. People are thinking about swimming and looking forward to the long weekend coming up.
Yes. Excellent. Well, fine. We have the same here in Chicago. Second on our panel is someone who's new to our webinar series, but someone we've definitely worked with and enjoy and collaborating with, is Clayton Brazale. I want to make sure I get that right, Clay, because yours is not the easiest name. It's kind of like mine. Clayton Brazale, who's joining us from Orlando, in the Orlando area, in the Florida area. So how are you doing today, Clayton?
I'm doing fine. It's pronounced just like the country, Brazil. And although not spelled that way, it's been summertime in Orlando for quite a while. So we have been in the pool for several weeks, etc. We're into our summer season where it rains every day, about 3:30 for about an hour, and you can set your watch by it. But I'm glad to be a part of the conversation discussion today, and I'll be representing WEX from a virtual credit card standpoint.
Excellent. Thank you, Clayton, and we'll look forward to hearing what you have to say. And then finally, we also have my colleague who I work with on a daily basis, Pierre-Marie, who is joining us from the Atlanta office that we have in the Atlanta area. So bonjour, Pierre.
Bonjour, Constantine. How are you doing today?
We're doing good. We're doing well. And so again, Pierre is going to be presenting the some of the point of view of how e-payments integrates within the wider framework of P2P and how we do that here at Determine. And then finally, of course, I'm Constantine. I'm going to be our host and really introducing the topic and the idea of e-payments and what that means for organizations looking to either get deeper into them or adopt them for the first time. So this is our quick agenda. Introduction to the topic, Andrew's view of e-payments, an e-payment approach to virtual payments from Clayton, and then some of the scenarios for applying e-payments in P2P. And then finally, we encourage you to ask questions as part of the framework for what we're presenting here, to ask our panelists and their expertise on what we're doing today, some of the information we're presenting, and things that could help you in the field. Before we do that, I just want to briefly introduce Determine. For those of you that know us or for those of you that don't, we are a player in the source-to-pay market. We are a global company that represents over 300 clients all over the world, recognized by analyst firms, and really looking to try to make a difference in the source-to-pay market with ease of use, and in terms of promoting and encouraging cloud technologies for working in the source-to-pay framework. And as part of that, we have been an innovator in this space for quite some time. So as some of you know, we had gone through some integrations with other companies, including BPAC, who was a P2P provider. And as part of that heritage that we bring forth, our organization has really helped shape the procure-to-pay solutions market, having had some firsts in the market for some time. And as part of this discussion, we really want to focus on how, as an organization, we can promote the usage of e-payments and find the benefits therein that would integrate not only as a part of an AP framework, but as part of the technologies that you're using on your P2P technology that you may have today. So as part of that, this is really important that as an organization, we're really committed to helping our technologies adapt to your solutions that you have in your business. And from the look and feel, we really want to make sure that we reflect the needs that you have and how you use technologies that need to integrate with each other in the P2P arena. So as part of that, let's take a look then at why are we talking about e-payments today. One of the things that we'll notice is that if you look back at some of the literature out there and you look at the history, e-payments have seen a tremendous growth in the past 15 years. You know, we know that e-payments have been around. We know that there are various types of those that I'll allude to here in a second, but we see that electronic payments have increased in their use in contrast to the usage of checks, which are down more than 50% according to a Federal Reserve study that was done in 2013. And one thing we'll notice is that there are certain nuances based on region globally as to why the U.S. actually continues to rely on checks more than other organizations in other regions. But we see that this increase in payments has certain benefits that organizations are finding. What I wanted to place here then on this next slide is just really a quick landscape of some of the types of things that reflect what e-payments are. We know that e-payments are reflected in areas such as wire transfers, automated clearinghouse or ACH, as well as purchase and virtual cards, which is something we're going to highlight today in the webinar. And we can see that each of these different areas for e-payments has some unique characteristics that may or may not fall within what you're looking for using as an e-payment structure. For instance, there's different amounts in terms of transaction costs that can vary for using these different e-payment methods. We can see that there are areas that might be older in technology or require larger dollar amounts, such as wire transfers, compared to ACH, which tends to be also common, and the faster growing area that we see within purchase cards and specifically within virtual cards. We could see that the amounts vary, and then in terms of the requirements that organizations have in using these e-payments, there is no float component to a wire transfer, but there is a lot more flexibility for how an organization pays, sets up the payment for areas in the purchase card and virtual cards. So these different nuances and different reasons provide different options for organizations looking to enable themselves within an e-payment framework. But we can also see that, as I mentioned earlier, checks still rule the framework for businesses, particularly in the U.S. We noticed this based on the study that checks have declined as a form of payment 3% per year since 2009, and B2B checks specifically, as they call out in the report, had the slowest decline out of any category of check types. At $6.7 billion in 2012, B2B checks were still the second largest category of checks as reported by the Federal Reserve. So this is very interesting for us to take in consideration as to the opportunity that e-payments provide for businesses if they're looking to adopt those. And then finally, what we see here is that the U.S. is clearly lagging behind in the adoption of e-payments, and maybe as part of the discussion here, we could see or try to understand why this is. So some of the facts that we present include issuing and depositing of checks cost U.S. businesses between $26 billion and $54 billion in 2010. We can see that we lag in the U.S. behind counterparts in Europe, particularly the European Union as a framework, Japan, and even Brazil. American businesses and consumers wrote 21 billion checks in 2012, and we in the U.S. write 4 times as many checks as were written that year compared to the EU as reported by the European Central Bank. So if we put all this then into context, there's a lot of things that we can discuss, and what I'd like to do at this point is turn this over then to Andrew to highlight his experience in the research that Ardent Partners has done on this topic and how it impacts the organizational framework for accounts payable, and see what we could glean from this as part of what I've introduced earlier in the webinar. So at this point, I'd like to introduce Andrew Bartolini, and Andrew, you could take it from here.
Thanks, Constantine. Yeah, so maybe I'll just start before diving in, talk a little bit about one of the reasons why the United States lags other regions in the world, and for the most part, the jurisdictions or the regions or countries that have led the U.S. from a percentage of electronic payments, it has been sort of federal government regulation that's really been driving or mandating that type of transaction. For some countries and regions, particularly in Latin and Central and South Americas, there are concerns around, sort of taxing and VAT types of tax, and making sure that those are captured between B2B transactions. And so they're utilizing technology as a way to monitor tax compliance and also ensure propriety in business transactions. But the United States really is an area where interest has really started to pick up. And what I'm going to talk to you about for the next couple of slides is some of the highlights from our recent research study that focused on B2B payments more broadly. If we go to the next slide, I'll just talk a little bit about the research study and the demographics and what's represented in the data that I'm presenting today. So I've been covering the accounts payable automation and the e-payments marketplace for the past, I guess now going on 11 years as an analyst, and for the past several years at Ardent Partners, we've conducted an annual study focused on B2B payments to try to understand trends, to try to understand what leading companies that we would call best-in-class organizations are doing, and really try to understand where the market is heading, while also providing a snapshot of what organizations are focused on and prioritizing and dealing with in both the near term and future. As you can see here, right, so the survey is based on 176 respondents, most coming from AP and finance, and almost all coming from P2P. The data does tilt towards large enterprises, which we define as those with revenues greater than $1 billion. It does tilt towards North America and Europe, but it does also come from a more senior level of job role within the organization. So let's sort of dive in and want to go to the next slide. Talk a little bit about the context of why e-payments has captured more of the attention of AP and P2P professionals over the last 3 or 4 years. And it really sort of maps to the evolving role that AP is playing within the organization. I think that when many people think of the classic AP function, they think of a siloed back office organization, very tactical, very paper-laden, not aligned with the larger organization, not even really aligned with the procurement organization. That started to change in 2006, 2007. Part of that was driven by the introduction of true P2P solutions, solutions that first came to market under the banner of P2P, largely forgot about the AP function, and it was really almost a decade ago where solutions really did come and offer a true P2P capability, and began to be more widely adopted. I think that combined with the global recession really forced organizations to start rowing in the same direction and put finance and procurement onto the same page and speaking the same language for really the first time in their existence. But what we've done and what we've tracked, right? So this is a market that is much more evolving than it is sort of just sort of revolutionary takes and sort of dramatic moves in one direction or another. But what we started to see in 2014 and really last year for the first time was that AP, there began to be a much broader realization within the entire enterprise, but specifically within AP and P2P, that there's a lot of value in the information that is being processed by accounts payable. And it was really for the first time that we started to see organizations thinking about themselves as a more strategic intelligence hub, being able to provide valuable information to functional peers like Treasury and like procurement. So let's look at the next slide. And one of the challenges that has existed for years is the amount of paper that exists in the AP department, right? On the left-hand side, we see the percentage of inbound invoices coming in that are paper, right? So, 2/3 of all invoices today still are coming in via fax, via email, via snail mail. And it's been very problematic. On the payment side, right, a little bit further along from a payment percentage standpoint, and that I think speaks to in many levels the maturity of commercial card programs and sort of being a little bit further along the maturity curve than what's being dealt with on the front end of the process. But why is paper a problem, right? I mean, obviously manual processes are more error prone. They take longer. They provide limited visibility. They make it harder to be strategic, and in the AP world very specifically, they make it harder to resolve exceptions, and that's an issue that the majority of AP and finance leaders believe if they can solve the exceptions problem, they can become a much more efficient and effective organization. But what we've seen is that as organizations attack the invoice format and become more electronic on the inbound side with e-invoices and other ways of digitizing those invoices, that opens up opportunities for them on the payment side, and it has expanded their focus. So let's go to the next slide. So the view of AP transformation, right, has also changed over the past couple of years, and we do fundamentally believe that B2B payments will become a strategic business process over the next few years. It's not there yet, but the opportunity to add value to a long-ignored area is simply too great. Now, this chart is showing the responses of sort of expected changes within AP over the next couple of years. I think first we want to highlight that the vast majority of AP professionals believe that they are taking very direct strides as an industry towards more automation. Again, with a lot of the approaches that AP organizations have taken from an AP transformation standpoint, they've tended to look at it very linearly and begin by attacking the inbound invoice. But over the past 2 to 3 years, we've started to see organizations really define AP transformation to really look across the entirety of the process, including payments. And what we see here is that about half of the respondents in our study believe that AP really does have an opportunity to become much more strategic from the standpoint of making an impact on cash management and working capital, getting more directly involved in, or at least playing a role in opportunities in supply chain finance. And we believe that as organizations start to understand simply the amount of cash that is paid to vendors, as a percentage of your revenue, and the number of enterprises that simply aren't focused on trying to more strategically manage the how, the when, the on what platform these payments are made. We think that there's just extraordinary opportunities. So let's go to the next slide and look at what we think are part of the data here. I think suggests that there really is and has been an evolution in the priority of B2B payments, and simply looking at the top 2 priorities for B2B payments over the next 12 months. For AP professionals for years, and so doing a decade of research, conducting dozens of studies in the space, the primary priority, the primary pressure has generally been to reduce processing costs, right? Become efficient. That seemed to be the end game for AP organizations for many, many years, but that really has started to change, right? AP professionals, the P2P professionals are starting to understand that there is very rich information that can be extracted and that can be used, right? We're just talking about working capital optimization, and for Treasury to be able to gain insight and to impart direct influence over the timing of those payments can unlock extraordinary value. From the procurement side, those of you listening in on the procurement side, right, understand that the data, the spend data that is captured by AP and in the invoices can present extraordinary opportunities from a sourcing and a supplier management standpoint. Let's move to the next slide. We'll talk a little bit about why B2B payments are important to AP as a function and to AP leaders today, right? So I'm showing you the top 4 business pressures that AP managers and controllers are operating against in 2015 and 2016, and each of those are improved by a move away from paper checks and towards electronic payments, right? So obviously automating AP payments, the ability to collaborate. One of the challenges that a paper-based AP operation has is simply an inability to be a strong collaborator due to lack of visibility into status of invoices, into status of payments. When you can't be responsive, and it's still today the average AP staffer spends more than a quarter of their time responding to inquiries. Those can be inquiries from internal stakeholders, and quite often they can be responding to inquiries from suppliers. So let's look at the next slide and talk about the benefits that those that have adopted electronic payments are seeing in the market today, right? And so these sort of map back to the pressures that they're facing as well. Those that have adopted e-payment solutions and they're initiating programs see benefits from an efficiency standpoint. They see benefits from a cost-saving standpoint, and we expect that as these programs take hold and more throughput comes through the electronic payment side of the operation, they're going to see increased accuracy and control of payment delivery, right? I think that's often an understated value. Let's look at the next slide here and talk a little bit about the challenges, right? So it's not without challenges. If you just hit click, the challenges here, right? So, the unique nature of P2P solutions, right? So, unlike other functional areas, right? When they deploy a new system, right? An HR system, a finance system, a CRM system, they're generally almost entirely reliant upon the employees of the enterprise, right? So they have direct control over those users. With a P2P system, you're reliant upon a third party, someone who sits outside the four walls of your organization, and the challenges that exist across P2P, and for those of you that have done e-procurement deployments, those of you that have done e-invoicing deployments, e-payment deployments, P2P in general, right? The Achilles heel in all of this is supplier enablement and getting suppliers on board. But I think if you move to the next slide, the point that we would make, and the point that is starting to resonate with more suppliers today, is that becoming enabled onto a platform, e-payment platform we're talking about very specifically here, yields some very direct benefits, right? I want you to put yourselves in the shoes of your suppliers, who are maybe emailing in an invoice to you, maybe they're snail mailing an invoice into you, and think about the challenges that they have in now understanding, has that invoice been received? Has it been approved? Are there issues with it? Isn't it, was it an exception? Is there something that they have to deal with? And that entire process, can be, they're flying blind if there's not a system in place. This carries all the way through to really the most important part from the supplier standpoint. It's not necessarily whether the invoice has been received and approved, but when are we going to receive payment, right? With e-payment systems, many provide visibility into the status of the invoice and the approval, but also the payment when it has been scheduled and when it is likely to settle. This drives improved cash forecasting, right? If you go back to 2008, 2009, when credit markets are tight, this becomes very important, right? And if you start to think, more broadly about the relationship that you have with your strategic suppliers, the world is increasingly global. It's increasingly competitive. Innovation and shifts in market leadership are happening all the time. Businesses are more reliant upon their suppliers and their supply chains than ever before. You really can't afford to be the high-cost, problematic customer to your strategic suppliers. And e-payment systems have the ability to scale across and provide very direct benefits to your strategic suppliers and to your tactical suppliers as well. So let's go to the next slide. I'm not going to spend really any time here. I think Constantine really covered the different payment types. I would say that sort of to supplement what Constantine was talking about, what we generally recommend for companies that are beginning a B2B payment initiative or B2B payment transformation initiative, we often recommend that organizations take a portfolio approach to the different types of payments and really map the different payment types to different suppliers, right? You'll find that there are different suppliers that are more appropriate for different payment types. But I'm going to maybe conclude here with one slide to really talk about the opportunities, if you go to the next slide, that I think really speaks to the potential for simply within AP, right? The opportunity to move to a more electronic B2B payment operation. What we see here, right, in the I guess in the left column are the different metrics that we believe are important to a B2B payment operation. But we have the two other columns. In the middle, we have the best in class, and that's the top 20% of industry performers. In any Ardent Partners research study, we will segment those top performers based upon how the metrics or how they perform in certain operational and financial and performance metric areas. The all others represents the the vast majority of the market, the other 80%. And what we see here is really a pretty broad gap between the average cost per payment for the best in class and all others. So if you were to think about the number of vendor or supplier payments that you're making on a weekly basis or biweekly or monthly basis, probably more likely, what you see here is that those dollars and those that cost differential can be quite extraordinary. It adds up pretty quickly. What explains that? I think you start to look at the percentage of suppliers accepting e-payments, right? So not necessarily an extraordinary gap, but what you do see is that the percentage of payments being made, or the volume or the throughput being made to those suppliers, is significantly higher. We talked a little bit about dynamic discounting. We didn't talk about that too much today. That's an area that's emerging, but we do think that straight-through processing and the percentage of suppliers that are enabled by the best in class, tend to be, good indicators of the direction that they're going. And these are just metrics really geared towards the AP department. What happens, though, is that when you have an operation that is largely electronic, that can provide visibility, really does enable organizations to start to think about their supplier payment strategy and how they manage that in a way that's much more accurate and precise and can drive extraordinary value. And that usually happens through a conversation with AP and Treasury. But certainly many opportunities and many different types of platforms to be utilized. And I'm going to pass it back to Constantine here as we continue forward.
All right. Thank you, Andrew, for that insightful look into your research. And again, as part of what we said here, is one of the things that we noticed is that with regard to the topic of e-payments, that virtual card payments is certainly one of those areas, and which is one of the reasons why we invited Clayton here to talk about his experience there within WEX and what we're seeing emerge and how there are some advantages to using this particular approach, perhaps as a way of enabling your supply base. So I'm going to go ahead and turn this over to you, Clayton, and give us your thoughts here from the WEX perspective.
Thank you, Constantine. I appreciate that. A little bit of background on WEX. I'm not here to sell our company. I'm here to talk about virtual cards. But a lot of people once knew us as the Right Express Corporation, and it's a company founded in Portland, Maine, and at the time, about 30 years ago, and at the time was focused, and still is focused, on universal fuel cards on our fleet management side. We developed a MasterCard, partnered with MasterCard about 15 years ago, began issuing purchasing cards and things of that nature. Our focus is almost entirely on virtual cards now, which was part of the initial inception of our partnership with MasterCard, in that the online travel industry needed a way to purchase hotel rooms and then resell them to their customers and be able to lock down the payment value so that it cannot be authorized for even a penny more than the set amount. That's where it began, and then we expanded into other business verticals, which picked up on the concept as well. As it says here, we did about $18 billion in virtual card payments in 2015, and will exceed $20 billion in 2016. Basically, a virtual card, and I say the word card many times, but really we're talking about a card account number, 16-digit MasterCard account number, or in the case of whatever issuer you use, could be American Express, could be Visa, could be other issuers, an account number, an expiration date, and a CVV code, which is the 3-digit magic code on the back of typically your MasterCard or Visa plastic. It's set for a specific dollar amount, and there are variables within the industry as to what companies want to do with that specific dollar amount. But just like any other credit card transaction, the vendor that you're paying will receive funds within typically 1 to 2 days after they enter that card account number into the point-of-sale system. It eliminates the paper check involvement. It eliminates the mailing involvement, the cost associated with banking charges of checks and check reconcilement and things of that nature. And so it becomes another version of an electronic payment. Much like a check, or maybe much different than a check, virtual cards have the lowest incidence of fraud in any payment form, including checks and including other credit card payments. It's almost nil. I can't say that it'll never happen, but it is almost a non-event when it comes to a virtual card program, because of the controls that we are able to set on that card, including the dollar amount being paid and various other settlement issues or authorization issues, such as merchant category codes over the type of merchants that you may be trying to pay. From a financial standpoint, not only the issuing company not only saves over the things I've mentioned earlier, postage, check reconciliation, check charges, payment charges, things of that nature, check stock, but there is always a financial, generally, let me say, a financial incentive involved from the issuing bank as a form of revenue sharing, which can be significant. Again, I'm speaking from a WEX perspective, but I would suspect this being available at most any of the larger credit card issuers. We have the ability then to send either an e-fax or an email of the credit card, as you can see here, the card plastic that never existed, but at least a mocked up example of what the front and back of the card would have looked like, because sometimes the merchant, the vendor on the other end, is just uncomfortable. They don't understand what a virtual card is. It's really nothing more than just like a phoned-in transaction. They are going to have to take this information. You are able to append invoice and PO information and things of this nature, as well as your own logos and instructions as to what to do, i.e., please enter this into your point-of-sale terminal as soon as possible in order to get paid. But just to give the vendor that's being paid a little more comfort, we have the ability to do that in an e-fax version, or on the next page, an emailed version, same kind of documentation with a mocked up image of the front and back of the plastic that never existed. virtual cards, just like plastic credit cards, are typically issued with a 3-year expiration date. But keep in mind, the expiration date is part of the algorithm that's built in the authorization process. That plus the 16-digit account number plus the CVV code equals an algorithm that the system is looking for. Many companies come back to and say, well, I don't want this card issued for 3 years. The answer is you don't have to. You can place controls that your customer is unaware of. I call them drop-dead dates, whereby the card may be active for 72 hours, 30 days, 60 days, 2 weeks, etc. And then the card will automatically die or reconcile itself and fall off the system, just like an outstanding check that's never cashed. In this case, the system will go in and automatically kill the virtual card. I can't speak for other issuers, but I can say from a WEX standpoint, from a security standpoint, once a virtual card is issued and used, it dies, it falls off the system, and it'll never be used again. We don't recycle account numbers. From our perspective, and typically from most issuers' perspective, you're going to have visibility into an automated environment that's going to show you the status of that virtual card. Maybe the next slide will show a little bit more information, such as, again, the date it was issued. In this case, these were transactions that were issued for an automobile extended warranty company. Things like vehicle number, PO number are going to be relevant pieces of information, and you can see when the item was issued, when the item was posted. If in the event that the receiving party decides, if you create a virtual card for $1,000, and I don't know why they would, but let's just say the receiving party enters $800, that $200 remains open to buy until the controls from a timing standpoint take over that you've negotiated with your issuer. You may say, once a transaction comes through, kill the card. You may say, leave the additional $200 open to buy for 14 days and then kill the card. These are controls that, again, are beyond the 3-year stated expiration date, which they need to enter into their point-of-sale terminal. These are behind-the-scene controls that your vendor that you're paying will never be aware of. They're controls that you place and can differ from customer to customer and from industry to industry.
Okay, excellent. Well, thank you, Clayton, for that insight. Again, for those that may not be familiar with the idea of virtual cards or the nuances, I think this is a tremendous set of knowledge that people are taking away to understand this within the wider context of e-payments. And so for our final panelists, what we'd like to do here is understand that these e-payments exist often within the framework of a wider procure-to-pay solution or business process. And as part of Determine, we often are looking at what our customers are looking for in terms of enabling and onboarding the suppliers for various types of payment methods that need to initiate from a procurement, from a requisition, that go through the procure-to-pay process and then ultimately result in some form of payment. So what we're going to do in this next and last session is have Pierre talk a little bit about how we incorporate things like virtual cards into our process and make sure that that's fully enabled for a complete procure-to-pay process from beginning to end. So Pierre, why don't you walk us through this and understanding the logic for what kind of workflows and how this fits within a wider procure-to-pay process?
Sure, thank you, Konstantin. So what we are looking at here and what we laid out in this slide is the different processes that we are going to find in the P2P, the purchase-to-pay environment, and how it relates to payment. But one of the first things that we can notice on this slide is that the payment always happen at the end of the flow. So if we look at the number one process here, the pick-out credit card. So purchasing through a credit card, can be done directly in the P2P system or outside the P2P system. So either users are going to go and raise a requisition and associate a credit card within this requisition, within the system, in which the PO will carry the credit card information to the vendor, and we assume that the vendor obviously has been onboarded on the credit card or P-card capability. And in this case, an invoice, a statement will come at the end of the month, and there will be a reconciliation of the statement with the different POs and purchase requisitions, and then the payment will be executed. So this is the level, the first one that we're talking about. Then more as a core of the P2P, we have other processes, such as we are going to receive an invoice from the vendor. No PO has been raised really for that invoice. Then therefore this invoice will be routed through a process of coding, the GL coding, then will be routed through an approval, the TOA or whatever type of approval routing that the organization can have, and then will result in the payment. When we talk about payment here, I mean, it can be the payment directly outside of the P2P or the payment directly issued from the ERP or the GL solution. This payment that we're talking about here, I mean, obviously we've talked about ACH, we talked about checks, which are the two main type of payments in the B2B business. We start to see also obviously P-card payments that can be done at that stage, and we will look at how the virtual card actually really embeds into those processes. The third level, the third type of process we're talking about is more for like recurring payment. So here we have a contract. We have contracted services with a supplier or with a partner, and those services will be billed on a recurring basis, maybe every month, every quarter. In this case, an invoice will be received from the supplier. This invoice will go and match against the contract, and the payment will be issued. Again, I mean, this payment can be done exactly as the other payment, either by ACH or checks or card. Then what we can see as well is that we have a purchase order. Maybe it has not been received. Then the invoice, when the invoice will come in, will go through a two-way match. Since we didn't have any receipt, manual receipt, then this invoice will be sent for approval, routed for approval, and then the payment will be issued. And the last one, which is the most common of the P2P, we have a PO, we have a receiving, we have an invoice. There is a three-way match. When it matches, then we send it for payment. And those are basically, in the P2P world, I mean, those are the different cycles of managing POs, receiving invoices, and issuing payment. But again, what's very important here is that these payments are occurring at the end of the cycle, whatever happens. So between the purchase order, which is raised, the potential approval, the receipt of the goods, the receipt of the invoice, the approval of the invoice, and then the actual payment, there is a fairly long cycle of and it takes a lot of time actually from the PO to the payment. And one of the things that we're looking at is how can we shorten this cycle, and how can we also automate this entire cycle? Because if you look at each of those steps, I mean, each of those steps are involving someone to review a document that has already been created by someone else. At one point, there is a lot of redundancies and a lot of it's a very labor-intensive type of processes. So what we were looking at with the virtual card is exactly to, a little bit like the P-card, so to be able to automate and to guarantee some of those payments and decrease the risk, but also how can we embed that within a P2P process. We're going to see that here is a more detailed view of a purchase-to-pay process, and how does the virtual card actually fits into this process. And I did put some of the WEX logos here because that's basically how we would process with WEX. So initially, we are going to start from the purchase requisition. So every end user in the organization who have access to the cart, who have access to the self-service purchasing portal, can get into the cart and access to the goods that they want to buy. At that stage, when they found what they're going to buy, I mean, they're going to issue a purchase request, and this purchase request will be sent for approval within the organization. So again, we're going to follow the TOA, the approval matrix, and once the purchase request will be approved, at that stage, the system is going to contact the WEX API to issue a virtual card request. And the WEX API will return an actual virtual card number with the amount required for the transaction which is requested. So that means that at that stage, we have a requisition which has been approved. We have a virtual card number that has been issued for that exact transaction, and we have an amount which is the exact amount required for these transactions, plus or minus the tax and shipping. But the idea here is that we have everything available to provide to the supplier in a very secured environment. Because when we are going to issue the PO to the vendor, this PO will carry all the information that has been provided from the requisition and from the virtual card request, and those information will be available for the vendor. So then the vendor, so if there is any issue or any problem with the PO, or there is any type of hacking which is happening, we are working in a very secure environment. Because actually this is a virtual card, because this is a one-time card which is used for a one-time purchase. And as Clayton mentioned earlier, I mean, there is a lot of security embedded into the virtual card process. They are not reusing the numbers. Those virtual cards are issued for a temporary period. So that really decreased significantly the kind of fraud we can find with standard cards. Then, I mean, the PO will be sent to the vendor. The vendor will be actually paid through the credit card. So here we have the credit card processing. So here we have multiple options. Either we can execute the payment directly, or we can execute the payment upon the good receipt. So there are multiple options here. But the idea is that now you can negotiate some very thorough payment terms with your vendors even before they issue the actual invoice. I mean, as soon as they get as soon as they issue they provide the good or send the good, I mean, we can issue the payment, so you can get a significant rebate from your vendors. And in the meantime, one of the big benefits you're going to see here is that we are not going to try to reconcile an invoice with this entire process. What we're going to do is that we're going to receive the virtual card statement, and this virtual card statement will be aligned item by item with the purchase orders that have been provided. So here we're really significantly streamlining the reconciliation process, because basically we're arriving at the 95% type of matching. So this virtual card will be realigned with the line item of each of the POs and each of the purchase requests. This statement will be routed to approval to each of the potentially to each of the cost centers or budget owners if needed. But again, I mean, this is optional. And then we will go through a process of payment of the credit card itself. And this is a very standardized process. So the idea here is that we are increasing significantly the risk of fraud. I mean, no, we are decreasing, sorry, the risk of fraud. So basically we are almost eliminating it. So that's a strong point of the use of virtual card within the P2P process. And we are streamlining significantly the effort of reconciling an invoice and a PO, and the entire process of going through the discrepancy management. So, I mean, this is where we see some of the virtual cards. So if we summarize a little bit what we discussed, so virtual cards have some of the same advantages than other P cards. I mean, it's going to streamline the invoicing process. It ensures the early payment discounts. It provide annual rebates. So, I mean, that's some of the those are some of the benefits that we see with the P cards. But in addition, I mean, virtual cards are almost eliminating the risk of fraud. I mean, we have a unique card number which is issued for every transaction, with the actual dollar amount which is limited to the amount requested by the end user for the purchase. So in a nutshell, I mean, that's a little bit how we are using the virtual card within the P2P process, and the benefits that our clients can see by this process.
Excellent. Excellent. Thank you, Pierre, for that kind of putting the whole e-payment and concept into context for how someone would then try to enable and try to automate the process as part of the wider framework. So I guess the question here, I guess in your last slide that we had here is is where do we start? And these are some of the things to consider when you're dealing with e-payments as part of the wider, I guess, wider framework for the things you need to think about is how do your suppliers then need to be onboarded to get to the point of being able to accept e-payments? What's the process for statement processing? What do the transaction volumes and fees look like to make this an economic and financial decision that is a positive one for both the buying organization and the supplying organization? And then finally, what's the overall culture? And we kind of hinted at this earlier. What's the overall culture of the e-payment approach? Is it very regional? Has there been a history of e-payments? What organizations are international, and how are you looking to adopt this? Are there some legal or compliance reasons because you're working in places like Latin America that may necessitate this over having to deal with check payments? So these are all the things that we can consider, and by no means are we solving this problem here on our webinar, but I think we're providing a real good framework to think about e-payments in a broader sense. So at this part of our webinar, we have about 5 minutes left to reach the top of the hour. I hear that we have some questions that have come through on the webinar. I encourage you to submit some more, but we did have a question really at the top of the hour when Andrew was presenting that was specific to the idea around the following. It said, Andrew, any thoughts on why half the companies see AP as strategic role in supply chain finance and cash management? That seems awfully low. So his question was around the role of AP as part of this bigger process. Do you have an answer for Doug on that?
Yeah, absolutely. So first, it's a great question, right? And so this, they're referring back to the slide that talked about, what the AP leaders think is going to happen over the next couple of years. I think, simply put, you have to look at where AP was starting from. And many organizations are more advanced. They are aligned with procurement, right? That's something that we've seen in our procurement research is that about 75% of organizations now are sort of walking in step together. But there's still an extraordinary amount of paper and in the average AP department today, and that problem at some level needs to be solved first before AP can readily go out and begin to engage more aggressively or more proactively with Treasury. So second part of that is where AP sits today, and one of the reasons why AP transformation and sort of the holistic view of looking at the entirety of the process is how AP transformation is defined today, is that from where it sits, right, the leaders within AP are not as significantly placed within an organization, right? Within procurement, they're the functional partner they're most aligned to. There's a C-level chief procurement officer in about 85 to 90% of organizations today. AP really doesn't have that voice going forward. So from where things were, 50% is actually a pretty optimistic view. I mean that's a big step forward, right? They're now getting into the conversation. Okay, excellent. Thank you, Andrew, for that answer. Another question here will relate specifically to the e-payment with P-cards and virtual cards. A question here from Senthil was, are there rebates available in using P-cards or virtual cards? I think we hinted at that, so maybe we could provide a little bit of a better explanation of that, Clayton or Pierre.
I'll take it first, if that's okay. We prefer to use the term revenue sharing. Rebate sounds a little bit nefarious, but that's used in the industry quite often. The answer is yes, you would negotiate that with your issuing bank. It's typically both volume driven as well as speed of pay driven. The shorter the billing and repayment cycle, the higher the rebate will be, because the issuer's cost of funds is reduced, although cost of funds is almost nil today. So yes, there are revenue sharing / rebate options back to the client. Most issuers will set a minimum annual spend for the rebate to the revenue share to kick in, and that's simply because there's a cost that the issuer has to incur quite honestly, whether the transaction is for $10 or for $10,000, the cost is the fixed cost is the same.
I could add something here. I mean, in addition, I mean, in terms of revenue sharing, it's important to understand as well that with this process, I mean, you're going to hit the mark on every payment term that you've negotiated with your suppliers. So technically, you're going to be able to benefit of the discounts and rebates or overall revenue sharing with your vendors. And that's something which is quite important because it does actually bring a lot of cash flow in the company.
Excellent. So I guess in the end, this becomes a revenue generating enterprise in addition to the payments, and so there's a win-win for all the parties involved. So I think it's a great question, and it's a great way to understand again the value of e-payments. I think the last question is we're at the top of the hour, which is a softball I'll take real quick, and then the last question that it just literally came in. Will this presentation be available online? I'd like to share it with my executive staff, Donna, and everybody else. Yes, absolutely. We will post this on our website. The actual recording of the webinar for the details beyond the slides will also be available. So please feel free to share it as soon as we post that with our marketing team. And then finally, one question, if you're willing to hang on for beyond 11 o'clock. I'm not sure if we have all the detailed information, so don't specifically quote us on this, but the question is from Augustina, which U.S. banks currently offer virtual cards to business? I think generally most banks publish whether or not they have virtual cards, but maybe, Clayton, you could describe your experience there in the marketplace with the number of banks or just a high level of what that looks like.
Certainly, it's going to be your larger credit card issuers, the ones that are focused on B2B payments as opposed to consumer payments. That would be WEX. Again, we would compete. We do own our own bank in Salt Lake City, and it's domiciled there because of the laws in Utah are favorable for credit card companies to be there. That's the reason American Express is there, etc. But the money center banks, such as B of A, Wachovia, PNC, etc. Not Wachovia. What did they change their name to?
Yeah, I forgot now.
I forgot to Wells Fargo.
Is it Wells
exactly.
Fargo?
Fargo, yeah.
I'm sorry, Wells Fargo. So it would be your bigger money center banks, and I'm proud to say WEX competes with heavily with all of those.
Okay. Excellent, excellent. Well, if you're willing to take this to the green room, I'm willing to take it to another question here that Leroy asked, which is actually a fair question because we're a little bit North America centric. And the question is what about for Asian markets for the virtual cards? Again, I'll throw that over to you, Clayton, or Andrew, or Pierre, our experiences there respectively.
I'll be glad to take my part of it in that, again, with my organization, we have the ability to issue and settle in about 16 different currencies. That's important because if you're able to issue and settle the card in the currency of the country that it's being used at, you eliminate the cross-border fees and FX charges as well. Many of the money center banks have that capability. I can't give specifics because I don't know all of those, but we can do that, and that's important because WEX is a global company.
Andrew or Pierre, any thoughts on that with the expansion and growth of e-payments? Again, because we talked about U.S. lagging behind adoption. What are your thoughts on?
Yeah, sure. I'll just say that, you know, where the market is today, you know, globalization has expanded on the procurement side. On the payment side, there are not necessarily what we would consider, you know, truly global payments that just sort of easily plug and play into different regions of the world. And so it's a consideration, right, as you start to go forward. I only touched upon it for a second, but the need to really start with a portfolio approach as you look at your supply base, where they're located, the types of payments, the frequency of payments, and the amounts of payments that you're making, you then begin to map the solutions, you know, to that supply base. So I think it starts with an analysis of your suppliers, and then you have to look at the solution providers and the different solution platforms to make the determination of where you're going to be most efficient, most effective, and drive the most savings and drive the most revenue in the case of the card programs.
Pierre, did you have a thought on that, or?
Well, I mean, above and beyond. I mean, as we've laid out before. I mean, the practices are different in Europe and in the U.S. I mean, when I started to use check when I arrived in the U.S. 12 years ago, never used check before. I think the payment process. I mean, electronic payment process in Europe is a bit different. However, I mean, I believe the virtual card is really, especially in the B2B world, is really a transaction that makes sense because it's directly linked to the payment to the purchasing act itself, and completely linked to it. So I think this is something that we are going to see rising both in the U.S. and in Europe very quickly.
Okay, and in Asia as well, and as we mentioned. All right, well, I think that's all we have for now. I think what we want to do is conclude here and just, again, if there's any particular question, sorry about the slide here, Andrew, about his research, what he's doing there, please feel free to reach out to him on his payables place and then Ardent Partners. And then again, if you have questions about the webinar and want to reach out to us specifically more about what Clayton presented or what we presented, feel free to reach out to us on our new website that we just released yesterday. And we always, as we like to thank people for participating, listening in on this educational and thought-provoking topic, and look forward to presenting more webinars throughout the year. So I want to thank my panelists. Thank you guys for joining us. And again, thank you guys for everybody on the call for joining us as well. Thanks a lot and have a great day.